Good afternoon. Hi, everybody. Good morning for Europe. Good afternoon for Asia. Welcome to our third edition of Fintech Bridge live streaming session. We're going to have another podcast today, but maybe before jumping in the context, and how are you, Harold?
I'm very good. How are you, Marianne?
Not too bad. It's Friday today.
It's Friday.
Yeah. Okay, so maybe before we introduce our speaker, like usually we do, I think one of the starting point is what I read, let's say, last month in The Economist. Actually, I don't know if you heard about it, but The Economist talked about DeFi. I don't know if you already heard about DeFi, decentralized finance, right?
I did.
But
maybe you can tell me more about the article.
Maybe you don't know enough on the topic. And actually, what it was interesting, so it's quite a long article, but what it was interesting is The Economist defines DeFi as one of the 3 tech trends at the moment. And so typically, if they were ready to put an article related to DeFi, I think it's quite important and it's a key trend. I think also they were defining DeFi as an offer, as an alternative path for spreading power. And so I think it's quite interesting. And this is also a topic that we have a look for a while at SC Ventures.
Yeah, I think it's a very promising topic for sure. For us, I would say as a financial institution, it brings a lot of questions. And I would say at SC Ventures, obviously we look at investing in disruptive technology, disruptive industries, and this is one that we're really interested in. And we'll introduce Aaron in a few minutes, who can talk about his experience. But just to give a little bit the scale of DeFi, this year, in terms of the total value of DeFi now stands over $100 billion. So it's just to give you that perspective. And obviously a lot of talks around cryptos, a lot of talks about blockchain, and we'll try to at least maybe define a little bit some of that today.
I think the idea is for like the previous episode is to give for the audience a flavor of what are the trends, what's happening, the landscape, but also talking about technology because it's Fintech Bridge, right? And we talked about technology, but not only technology, what is important for us is to link with business and business use cases. And we're going to have the opportunity today to talk about that. So as you have understood, probably today it's a podcast about DeFi. DeFi has been a topic for this month for a Fintech Bridge campaign. So we call that Transformative DeFi. And I think today we're going to understand a little bit more about why and how it is a shift and a transformation for financial services.
It's a very nascent industry. Yeah. Obviously, it has a huge potential. It can completely shift things around in terms of the different stakeholders, in terms of the different people who are involved in the financial industry. But obviously, there's a lot of questions around regulation, around security. Mm-hmm. We've talked about some recent losses of people over some of their cryptos that were gone. Mm-hmm. So I think these are some of the questions that concerns that are on the minds of people, and obviously the legality of this. And so to talk about this today, we have 3 different perspectives. We have someone initially from the bank. Well, he's still with the bank. His name is Aaron Guak. He's head of capital markets at Standard Chartered, and he's also the founder of Liberty, which is one of our fintechs at SC Ventures aimed at democratizing access to bonds to retail investors. Aaron's passionate about this topic. He's very knowledgeable.
All our speakers are super passionate about the topic, right?
They are. But yeah, welcome, Aaron.
Seasoned and passionate.
Seasoned and passionate, absolutely. Welcome, Aaron.
Welcome.
Thank you. Thank you for having me.
And then we have an old friend, but I shouldn't say old friend because it doesn't sound very positive. We have Benedict Nolens. Friends because she was one of our ex-member at SC Ventures. She's now head of BIS Innovation Hub in Hong Kong. Huge expert on that topic, and you will discover it during this session. We are glad to have you with us. Benedict, welcome on stage.
Well, thank you very much, and thank you for having me back. It's I think about a year and 3 months since I've left SC Ventures. So yeah, I think it's my first official coming back to you. So thank you for inviting me. Yes, and I would say it's hard to say anybody is a real expert on DeFi, and then we'll get to the definitions later, because it's highly evolving, and the term itself seems to have been focused on what's been happening in the last year. But if you mean an expert on crypto, yes, I've been a long time in the space, if you think about where I started on this, yeah.
Well, thanks for joining us. And we also have Ratko. Ratko is actually a short for Radoslav Albrecht. I'm probably completely misspelling your name, so apologies for that. So Ratko is the founder of Bitbond, which is one of the fintechs that we work with. He's helped us really think about private versus public blockchains for a few of our topics, and is actually one of our partners with Liberty. So welcome, Ratko.
Yeah, welcome. So
Thank you
now
so
that
much
we have
for having
introduced our speakers for this podcast, let's jump in a little bit about into the questions. So maybe the first question, and I'm sure there are people in our audience that are maybe not familiar like you guys with DeFi. How would you, I mean, if I have to tell you, okay, give me one short sentence or short definition of what is DeFi, decentralized finance, what would you say? Who wants to start? Because it's a question for all of you. Haron?
Well, I guess if I start and say DeFi is a myth, then I guess it's not very. It's a little bit more.
It's like the end of today's session.
We'll wrap up very quickly. But no. But I do want to make a few distinctions around DeFi. And again, decentralized finance, as we define it, as is defined, is about not having a central, clearing or someone in the middle that people themselves can interact with each other, like cash. I can pass cash to Harold, and no one has to be involved in that transaction at all, and that would be it's a proper transaction, and no issues there. But I think the few things that people try when we talk about DeFi, there's an enormous focus around DeFi with relation to currency. And one of the things that I do want to try and differentiate is that currency and securities are very different, and we have to look at them very, very differently as well. The second thing as well is that the level of DeFi that we talk about, we need to keep things in context, because even cash, the ultimate DeFi as we talk about it, is created by someone and is responsible by someone to make good on it. It's amazing how $100 bill it has so much power, but technically it's a piece of paper, right? So there has to be belief that is ultimately valuable, and that's really the central kind of theme on that. So again, I think that, rather than define it, maybe I'm kind of reverse engineering and trying to clarify a few points that I found interesting when we talk, when I hear a lot of people talk about DeFi.
Okay. Ratko, maybe? What about you?
Yeah, maybe I would add 1 or 2 points. What DeFi does is it takes over some of the functions that banks typically would do, and does that in an automated way. So a bank would match borrowers and lenders, take on capital on one side and then handing out loans and financing on the other side. And then you have stock exchanges, for example, that are matching buyers and sellers of assets. You have insurers who match someone who wants to buy insurance with someone who wants to sell insurance. These are services that DeFi conducts in an automated way, purely based on protocols. So just like Aaron said, it happens decentralized. There's no one central counterparty that would make decisions, but there are rules that are put into code, and then according to these rules, supply and demand matches, whether it's supply and demand for capital, supply and demand for securities or other financial assets, or supply and demand for insurance. And this is pretty fascinating because normally when you look at the credit process within a bank, then it's super sophisticated and it is a lengthy process. And in DeFi, it gets automated. There are a few shortcomings. For example, unsecured lending doesn't work in DeFi. Everything is over collateralized. But I think it's a great look into what can actually happen when we put more and more of the rules that banks are applying in conducting financial services into code, and how that can help make financial services more efficient.
Okay. And I don't know, Benedict, if you want to add something before I ask my next question.
Yeah, so look, I liked Radko's definition very much. I think it's correct. I think it's the use of, to keep it simple, of technology and in particular smart contracts. So the use of code for executing finance. So I think oftentimes the question is, what do people associate it with? So right now people associate the word DeFi with unregulated. And I think to connect back to what Aaron was saying, I think what he means with it's a myth is the fact that if you automate through smart contracts a regulated service, it may still need to be regulated. And I think that is in somewhat a lot of the global regulators are trying to make clear. No one is denying that there is a lot of value in automating things. That's never been denied. And Standard Chartered, you have a very long history as a bank. So in fact, regulators are completely in favor of automation. But what regulators tend to also be in favor of is automation in a fashion where there aren't major losses. And then the major losses tend to be twofold: to financial stability or to consumer protection. So financial stability is when the whole thing collapses, like what we had at the global financial crisis. That's when the banking system, for example, collapses. That's something that bank regulators avoid. And what securities regulators avoid, to that distinction of Aaron, is actually they try to avoid consumer losses, so investor losses. And that's why they regulate. But most regulators say we're completely technology neutral. So in sum, if you do something with a smart contract protocol, and it is a much more efficient way to do a regulated function, whether it is in the securities context or in the payment context or in the insurance context, and you seek the same licenses, then I don't think there's any controversy around this. The controversy is around the fact that some people think that given DeFi, frankly, can go as far as letting the code govern without humans. And I would say the best example of that, in my opinion, remains Bitcoin to date, right? Because we don't know the human even. We don't know who he is. We know his name, but we don't even know he's still alive. So for these things, they become much harder to regulate, of course. So if you ask my view, then I think ultimately that DeFi must have a lot of opportunity in it. So I'm not surprised that you're running a campaign on the Fintech Bridge. But I also do think that a lot of the services provided in DeFi likely do fall in the remit of regulation one way or another. So if we need to look at this on a 5 to 10 year evolution basis, then it's highly likely that you see these services further develop, further expand beyond all the services we already see. And indeed, those are the services that the bank might be doing in different of its business lines. So you will see more and more creativity, more and more of these services. But I do think you'll see more and more of them who also will want to seek licenses. And if you again, to the distinction between DeFi and crypto, which I made in my introduction, crypto is going through the same evolution. 5 years ago, no one could get a license. I was with one, as you know, 4 years ago. We asked for licenses, and no one would accommodate us, to be frank. But now the regulators are at the stage where they give out the licenses. So what you see now is the ones that gain now the biggest, let's say, either valuation, look at their valuation, that's the easiest way to look at it. Those who gain the largest valuations are those that actually are the closest now to either getting a license or who already have a license. So in sum, I think you'll see DeFi evolve much as crypto did, from completely unregulated with enormous creativity, therefore innovation that others will follow, including banks, including even central banks, but from unregulated to regulated over the next, not year, but I would say 5 years.
And maybe just on that, I'd be interested in hearing Ratko's perspective on some of the obstacles that you meet when you talk to financial institutions, when you talk to regulators. What are some of the obstacles that you hear from them and that you think need to be solved in order to get to a point that Benedict mentioned in a 5-year time frame?
Yeah. So specifically in the context of DeFi, one challenge that you have is to identify the actors. So when you have an organization, for example, lending through a DeFi protocol, even though the protocols are designed in a way that you in theory should have close to zero counterparty risk, because the borrowers are always over collateralized, and if the value of the collateral goes below a certain minimum level, then the lending contract will automatically be cancelled, and the collateral is monetized and paid out to the lender. However, we have seen in the past that sometimes, even if the collateral was valuable, the smart contract that regulates the evaluation and the payout of the collateral was buggy, and therefore there was still a way to lose money for the lender. So this is more of a systemic or structural problem, and at the end of the day, a technological problem. Probably going forward, some of these issues are going to be solved, that this is far less likely to happen, but there still remains a certain risk. Now, as Benedict said, what regulators do, they want to prevent the financial system from collapsing, and they want to protect consumers. And so even if we don't have a true counterparty risk, there's still a technological risk that is introduced. Now, if the regulator wants to protect some of the participants, it would need to know who they are, because a bank is a known entity to the regulator. The regulator makes sure that in the, I would say, risk-taking activities that banks are conducting, they put behind those activities a sufficient amount of equity, and there are liquidity coverage ratios and several other measures that are helping the banks to remain stable. So from the regulator's standpoint, not knowing who's actually participating in DeFi applications is a challenge. And currently there are attempts to make progress there in order to actually know who to regulate in a system that is actually by design made at least pseudonymous, if not anonymous. So that's one challenge. And similar challenges actually arise with banks. Banks in many cases see the advantages of DeFi because it's more efficient. It means that borrowing costs, for example, are lower, returns to investors are higher. So these are clearly aspects that are very attractive about DeFi, and banks are trying to find ways to to utilize that and to take advantage of these efficiency gains. However, some of the challenges that the regulators face are also on the side of the banks, meaning they normally need to know who is the counterparty that they are dealing with. They normally would need to go through know your customer procedures, would need to go through AML checks on their counterparties. And this is something that, you know, if you utilize DeFi the way it's originally designed and the way it's being used today, you actually cannot do, because you don't know who your counterparties are. And so these are some of the challenges that banks and regulators are running into. There are, as I said, first attempts to solve these, but we're definitely just at the start.
Yeah, okay. Interesting what you mentioned about the technology and the idea of knowing the ID, which is a little bit opposite of, let's say, the principle of the blockchain and the DeFi. I think what I'd like also to hear is the view from Aaron. Do you share the same view than Benedict and Radko, or any other view or statement to add?
Sure. Look. I agree with both Benedict and Radko. But I think the elements of what we've picked up here that's interesting. But I think first of all, Radko mentioned counterparty risk, and that's something that is a big issue. People don't think of it as an issue because it's a tech or it's just a platform, but it's not. How it's designed and how counterparty risk is mitigated or not is something that people have to look through very carefully when investing, either as a participant or at a company level on some of these platforms. Also, I think, and again, given that I did, regular finance, or apparently it's called TradFi, a new word I learned, traditional finance.
New one, okay.
I thought it was trade finance misspelled, but hey, what do I know? But that's what it is. And apparently I've done that 2 decades. So one other thing that is also important is about eligibility. Is that person, you see, access doesn't mean eligibility. And those are 2 different things. If I had access to it, should I be doing it is a different question. And that also boils back to why regulators want to make sure that these platforms are within that compliance regimes and within licenses, because that is very important. And again, just to iterate, like what we're trying to do at Liberty, we're talking about democratization of access and all of that good stuff, and it looks nice and sounds interesting. But the truth of it is that what we're trying to do is very simple. We're trying to get the safest asset that an issuer can issue in a country to the end users that are the citizens in that in a very direct way between issuer and investor. And we're trying to do that because government bonds have the widest eligibility, like we're talking about. If you design this properly and have the issuer issue bonds as tokens, as native tokens, then you eliminate counterparty risk of the operator of that platform and directly link up the issuer and the investor. And that's the key notion of it. And why do we do this? It's because while government bonds should be birthright, and it's in fact the same counterparty when you get a dollar bill as a dollar bond, but bonds from an infrastructure perspective is far more complex. And that's where the true value, in my opinion, of DeFi comes. Why do we take it for granted that multiple layers of counterparties need to exist for me to buy my government's bond? Why should that be the case, right? Why can't it be, if I have $1 to save? In fact, if I have, and again, because I work for a bank, I shouldn't be saying this, but if I have $100 to save and I put it in a bank, you know what the bank does with that? They go buy government bonds with it. So, why not cut out the middleman, right? So, that's the idea. But today, it's actually quite cumbersome, and it's actually a lot of different processes. And most of those processes exist for different securities, but frankly, shouldn't have to exist for very simple securities with zero counterparty risk, with zero credit risk. And I think that's kind of what the whole idea of Liberty is. And that's where I think the best elements DeFi can exist in today's environment.
Aaron, you've tackled actually one aspect, which is native tokens versus other types of tokens. So we're actually going a little bit deeper into the conversation and into tokenization itself. But I think there's a few different solutions on the market right now. If you could explain very high level why native tokens are the answer and what's the difference with what you could see on the market right now.
Sure. I think a lot of people, when we talk about tokenization, they confuse it with factorization. So when you take a block of like a building, and then 100 people own the building, then it's like, yes, it's great. Then it means that it's everyone gets one token. Then it's tokenization and it's factorization. But then, are you owning the building, or the shareholder of the building, or are you owning the shares of the owner of the building? There are multiple levels of things that you think about when you think about that, and every barrier of that has a counterparty. So, for example, if I took a piece of cake and then I divided it amongst the 5 of us here, then I would have the authority to cut Benedict the biggest piece, because hey, she's in Hong Kong, and she's wearing this blue muffler that is nice, so I give her the biggest piece of cake. That's my thing, right? So I can decide how this works. If I take the cake and I disappear tomorrow, then there is no cake for anyone else. Does that make sense? Counterparty risk. So while the cake exists, and if I have control over that, that's when that counterparty risk really exists. So when people take platform investments, and when the tokens are not actual end originated tokens that have a direct link all the way back to the actual issuer, then in between, unknowingly, you're taking counterparty risk. And that's what I think is quite dangerous, because people thinking that, well, I bought half of that, or 1% of that building, but then the guy who set it up runs away or dies or whatever, then who has that record, right? What happens to that, right? So while we're all technology, cash included, it's just a means to an end, right? It's not the driver of anything. Technology has to be used to solve problems, not just for the sake of it. And also, just to create things because it can, doesn't mean everyone who has access to it is eligible to it. So it's always very important to match all of those things up. Now I sound like a regulator.
Any comment about the cake? I'm sure Benedict, are we really talking about DeFi with the cake, where you will have a bigger portion because you're based in Hong Kong with the blue scarf, right? Are we talking, if you're a purist, are we really talking about DeFi in this case?
Well, look, I'm with blue scarf today because our temperature dropped by about like 10 degrees less than 3 days. So this time it's not a decoration. My office temperature has equally fallen by 3 degrees. But so look, I think maybe to come back to what Radko said, I think or what I also earlier tried to say, and I think it's underlying all of this, is things. Let's face it, regulators try to reduce risk when they regulate something, but when something is not regulated, therefore it can be high or low risk. We don't know, right? Because it's not regulated. It's like, to take the cake example, a cookie can be unregulated, all cookies are. So it could be a good cookie or it could be a bad cookie, right? And so in DeFi, as Radko says, some people come up with models where you don't know the individual. So you don't know who's behind it. There's no entity, there's a DAO structure, and you don't know. I think it's an end situation. So if you don't know the people, There's no CEO, no one who goes with the word CEO, COO, CFO. You don't see any of those on LinkedIn. Plus, in addition to that, there is no entity. There is a declared DAO structure, which is a decentralized autonomous organization. Then you are completely unprotected. So it means it could be a good cookie or it could be a bad cookie. So in sum, if you put your $100,000 at risk there to get very good returns, nevertheless, probably around 10%, you may lose that 100,000 for the reason that Aaron described, because there may be somewhere counterparty risk that you as a consumer, an ignorant consumer here, don't actually know, right? So inversely though, if we take the same DeFi concepts and we use the same smart contract technology and we put it in a regulated context, right? Regulated by a regulator, then your risk is probably lower as a consumer. Now, I say lower and not nil, because to me, the global financial crisis demonstrated that even regulated does not reduce risk to nil. Now, to go back to, again, this distinction within the DeFi world, in my opinion, there are already two types of players. There are those who want to be completely unregulated, who say, I'm going to go for the DAO structure. But there are only very few where you don't know the individual. That's why I said Bitcoin is a classic, because there's code governing the process successfully, by the way, for many years now without breakdown, and there's no individual. For most of the DeFi pools, even if they try to set themselves up as a DAO, as a distributed autonomous organization, there is actually an individual that's out there on LinkedIn saying he's in charge of it. Now, I would say for regulators and law enforcement, the moment that there is an individual, they actually have an individual to go after if they wanted to. But that's still very different from being regulated, because if you're regulated by financial regulators, then the financial regulators keep a full list of the licensed parties within that entity, as you know. So it's kind of a scale of how unprotected you want to be. And if you want to be fully unprotected, then I said Aaron may be operating that pool and may take the cake away. And if you're in the middle scenario, maybe he'll give you a smaller piece. And if you're fully regulated, then maybe you get at least, what you transparently know you get. But sometimes inversely, the high regulated comes with higher fees, because higher regulation also costs money. And that's the spectrum of why you even see DeFi evolve, because people are trying to get fees down, and then one way to get the fees down is to become unregulated, right? Yeah. So anyway, I hope that gives you a little bit of an answer to your question.
I think it gives
just wanted to add one thing. Sorry, just wanted to add one thing that my dog's name is Cookie, and she's a good cookie. So just wanted to...
Is she on the blockchain?
Actually,
absolutely.
So I wanted
to just print out a new next NFT. Let's go ahead.
Nice. No.
I think we've covered quite well the different stakeholders and some of the challenges about DeFi. But let's go a little bit deeper into now, some of the technology and how the technology can be applied to DeFi. So if we were to make a first statement, maybe around blockchain, you have private versus public blockchain. What would be the one that makes sense for DeFi? Okay, it's a little bit easy as an answer, but why and why you think one makes more sense than the other?
And maybe what it would be also interesting is to link with the use case, because I'm assuming that depending on the use case, you will not use the same type of chain, right?
So maybe Ratko, you have an opinion on that.
Yeah, so thank you, Hara. That's one of the easier questions that can be asked around DeFi, at least for me. So DeFi, as the name implies, with decentralized finance, builds upon the fact that you have publicly accessible protocols through which you can use DeFi and provide services. And so in that case, a private permissions chain would not really work. A private permissions chain means that you have a consortium of 2, 3, 5, 50 organizations that agree on a protocol which they use in order to exchange assets, for example. which is fine. And there are some examples where this works perfectly well. In Italy, for example, there is the Spunta consortium where nearly all Italian banks are participating, and they use R3 Corda as an underlying protocol for settlement transactions. However, one of the core ideas of DeFi is to give everybody, literally from the smallest retail investor up to institutionals, access to borrowing and lending capabilities without them having to ask for permission. And if you use a private permission chain, then of course this whole concept pretty much is over. So in that case, public permissionless chains are actually the only option if you talk about the DeFi in its true sense and the way it was actually meant when it was set up.
Aaron, what about?
Yeah, no, look, I can sense that you're waiting for me to act out on this as well. But no, I totally agree with that, and I think the essence of it. You see, people think that financial institutions are the bad guys, but then if a tech company runs that centralized organization, then it's okay. It's not okay, right? Moving from traditional finance or TradFi into DeFi through a private permission chain is just moving the center of operation from a regulated financial institution to a tech company, essentially. The true elements of democratization and ease of access is only achievable and scalable at very small denominations through public chains. And again, while people think public chain means that all your information is publicly out there, that is really not the case. And we, I think the window cleaner has quite a bit of access to you, Benedict, right? You see, so
he wants my cookie.
Well, privacy and public. Now, very apt. So, what I was saying was really around the fact that it's not about breaching privacy. Public chain isn't about getting your information out there in the public. That's not what it means. But it's basically trying to use all of the resources that are already decentralized and already out there to your benefit, so that reinvestments to achieve what you need to achieve can be done in a much more efficient way.
I think we've talked about the landscape, we've talked about the different stakeholders, we talked a little bit about technology. I think, Aaron, you talked about democratization and and I think also the fact that there were, the centralized finance and the DeFi and the differences and also the technology. I think what it will be interesting is also to know, and probably with your first example, how this DeFi and how this technology that it can be used in a good way with, and we talked about the risk mitigation, etc. Which type of impact can you bring to society and to the end user and typically the clients? Can you maybe share a little bit, for instance, what you're doing with Liberty and what is the purpose of Liberty?
Yes, no, but I think maybe Benedict, you could tell us a little bit about Project Genesis that we're working with you on, and I think that's a great example of all of the above, and using technology in a socially responsible way. Benedict, maybe you could give us a little bit of the philosophy behind Project Genesis.
Yeah, so Project Genesis, the idea is that we tokenize government retail bonds. So to make it simple, in Hong Kong, the government places bonds to retail investors, and these bonds are quite highly desired because they do tend to offer a little bit higher return than a bank deposit. So what tends to happen is they tend to be fully sold out and sold out pretty quickly. But because of the way they currently operate, which is in quite highly, you could say, people, paper, and manual process intensive fashion, the minimum denomination in which you can invest is set at 10,000 Hong Kong dollars. So that's around, let's say, 1,300 US dollars. And so we were looking at tokenization specifically because we think it can do what Aaron had mentioned before, which is fractionalize it. So our goal was to fractionalize to, let's say, 100 Hong Kong dollars. The other aspect to the project, and this is why it's called Genesis, is because we make the specific use case for a green bond. And the idea is that specifically for green bonds, if you can bring the denomination down to, let's say, $100, 100 Hong Kong dollars, which is like 13 US dollars, then you can involve a much larger amount of the community into this. It suddenly becomes accessible. At 10,000 Hong Kong dollars, it's not accessible for, let's say, a student who wants to contribute to a bond that invests in a solar farm in Hong Kong, for example, right? At 10,000, they can't afford it. At 100, they can afford it. So the first element that's important, and that's why you use at the minimum and distributed ledger are a blockchain, and that's where the difficulty of this discussion now lies. So you use one of these to fractionalize it. But then that question you asked about public versus permission-based is really a difficult question. And I don't think I have gotten all the answers to it, and maybe Radko can fill in a little bit later. But as a broad sketch, the way I see this work is that for permission-based ledgers, I think they're very, very good for enterprise use cases. So if it's enterprise, if it's institutional, that kind of a market, I think that probably a permission-based ledger maybe has some features that make it possibly better, such as, for example, it allows for more privacy, but I'll come back to the privacy in a second. And it allows for maybe more high frequency trading, but I'm not so sure of that, let's say, even that aspect. Now, on the public ledger, on the other hand, I think for the context that we are here describing for Genesis, I think a public ledger, the only obvious downside it would have is if you can't do the KYC. But in the prototype that we jointly created, you do the KYC, and the bonds actually can only go from KYC to wallet to KYC to wallet. So I think there's fundamentally maybe two misunderstandings I need to a little bit sometimes hit on for public blockchains. A is that you can't do a KYC structure. With Genesis, we're doing a KYC structure, so AML compliance is complied with. And the second misunderstanding is often that people say with the public blockchain, there is no privacy protection, which I think is wrong. So in some, you can see the transactions, but you can't see the identity of the person transacting. And for under data privacy laws, the only thing that is protected is information linked to an individual. Is not transaction data are not protected under data privacy rules, right? So in some, I think public blockchains have very, very possible and really good use cases, and which is why, again, we use this Genesis project as an example. And by the way, the reports will come out towards November 3. So for anybody who wants to learn more, you can look at it then. But in some, importantly, for these public blockchains, nevertheless, to be reconcilable with regulation, the AML issue needs to be resolved. And in our prototype, because it is a very specific use case of Hong Kong government retail bonds, so confined use case, it is actually possible to create that KYC option around it. And maybe now I hand it back to Aaron to give a bit more on Liberty specifically and on Genesis. And maybe Radko, you can add your observations on public versus permission-based chains.
Absolutely, and thank you, Benedict. And look, again, the reports are coming out, so it'll be very interesting to see not only with regards to what is being achieved, but Liberty's small contribution to it. But the idea of Liberty, as I was describing earlier, is very much aligned to what we're doing and in building the prototype in Hong Kong. Through this Project Genesis as well. The idea is really to try and use technology not only to reduce the denomination or the entry point from 10,000 Hong Kong to 100. And then again, it doesn't have to be 100. In fact, technically it could be 10, 1. But going further from that, one of the other issues with the traditional retail bond system, which goes through intermediaries or banks, 40 over banks are involved in the distribution of this. One of the biggest issues there is that the liquidity of secondary trading actually doesn't really exist. So if I want to sell a bond, then I have to go to my bank and ask the bank to buy it for me, and they'll give you a face and they'll smile, and then they'll give you another face, and then they'll say it's 99 cents in the dollar, and you have to agree with it. There's no kind of transparency. Even if I wanted to just give it to Radco, I couldn't, because it has to go through all of those protocols, whether or not Radco was KYC'd or not. So the idea of being able to transfer that directly using technology that exists today in a compliant way that ticks off all of the boxes that regulators have for us in securities, especially government bonds targeted for retail, is what Liberty is trying to do. Obviously, we're trying to do that on a global scale, individually in country, not for Singaporeans to buy Ghanaian bonds or Hong Kong people to buy Malaysia bonds, but for the citizens of the country to be able to have the ease to have very small denomination access to, again, the safest asset they can access, and also to be able to transfer that freely without the need to go through a counterparty between people. And I think that's the goal that we have at Liberty, and we're very excited to showcase that on Project Genesis.
And maybe I know that Marion wanted to ask a question on Bitbon, but I actually had a question on the small denominations because you've mentioned what you're trying to do. Are there, and maybe that's more a question for Radco, but are there specific blockchains that are more relevant when it comes to what Aaron mentioned, very small denominations? We're not talking about institutional investors, institutional investments, etc., but small retail investors, small investments. What is your take on that? If we're to look at a specific blockchain versus others.
Yeah. First of all, what I would like to say is that some of the reasons why Liberty exists and the goals with it of smaller denominations and creating secondary liquidity, enabling investors to transfer assets from one person to another without, a big amount of intermediaries behind it, is something that gets me most excited about tokenization. So I think these are true benefits where we see that the technology actually can deliver something that's really useful. Now, when you look at which underlying protocols and technologies to use, what we typically do is we analyze the use case and then select the underlying protocol and other technologies based on the use case. So it's like buying a car, right? When you buy a car, you don't just go out and find the one that has the nicest color, but you will say, well, do I need this car for my family?
Well, speak for yourself, because that's what Harold does, but we're digressing.
Of course.
So of course, everybody has their own approach, obviously, but most people, I suspect, will say, well, do I need to transport 3 kids and I don't know, my grandparents, or is it just a weekend car where I go on a trip with my partner? And so the same is true when you select technologies. They have to be a fit for the use case. And in the case of Liberty, of course, it addresses retail investors, so there's potentially a high number of transactions. It means that it's cost sensitive, because when you have retail investors and they you want to have small denominations of maybe $1, $10, $100, then if transaction costs are, I don't know, $2, $3, or $4 per transaction, then it makes bonds not efficient, because the transaction fees would eat up all the interest and the coupons that investors are getting. So you need a protocol that is scalable and that has low transaction costs. There are several protocols that currently meet those needs. But for example, Ethereum, which is probably the protocol that everybody is aware of, and that is one of the most popular protocols for DeFi applications and for tokenization, is a protocol that actually right now doesn't really meet the requirements as good as some other protocols, because Ethereum currently still has pretty high transaction costs. Ethereum from time to time still experiences network congestion because it's so popular. A lot of people want to transact on it, and then when there's too many transactions, right now the transaction throughput on Ethereum is just around about 40 transactions per second. So it can happen that there's more people who want to transact than actually the capacity of the network. And so this is an approach that we normally take in evaluating what are the best technologies. Just one remark on Ethereum. I think it's going to change significantly. At the moment, 2.0 version of Ethereum is being developed and rolled out. There's a good chance that Ethereum will address some of these topics. But as it stands today, when you look at a use case like Liberty, we, for example, would not recommend Ethereum, even though we think it's a great protocol and it has a lot of good things going for it. But we normally recommend to consider the use case and then make a technology decision based on the use case.
Sure.
Marion, I think you wanted to ask a question about the interoperability maybe of different protocols. Are we ever going to be able to have, as Benedict mentioned, going from one wallet to the other? How about going from one protocol to the other? What is your take on that?
So this is, in my view, one of the big questions when you look at utilizing blockchain in finance, because a good comparison is the different plugs that you have in phones and in computers, right? If everybody was using the same, then the world would be much simpler and we wouldn't need to buy new chargers all the time. However, also we don't want to prevent technological innovation, right? So it's definitely challenging, and the same is true in the case of protocols. Right now, it's not very straightforward to move one asset from one protocol to another protocol, and it means that compatibility is an issue. The good thing is that there is a lot of custodians coming up and custody technologies coming up that are actually compatible to several protocols, which means that you can transfer assets easily between one investor and another. But this is certainly one of the bigger challenges that yet remains to be solved. Do we find technologies where we can easily swap assets from one protocol to another, or will the market actually establish just one or two protocols as their standard and no other protocols will be used for asset tokenization? Certainly one of the big questions of the space.
Maybe one final question for me, and I think you have a final remark as well.
Actually
we've gone over time, but it's a passionate topic.
Have we dropped all of our users? I mean, are people still on?
They're still on.
They're still on. We were checking.
But actually, I wanted to go back to your opening, Aaron, when you said actually when you think about DeFi, there's a clear segmentation between currencies and securities. Well, do you think that is always going to be the case, or do you think at some point we'll be able to trade currencies with securities? And what are some of the biggest challenges? I'll start with you, but I'd love to hear Benedict's point of view and Radko's as well.
Again, I think securities and currencies, are two things that perform different tasks, right? Securities, especially from a bond perspective, for example, someone owes you money, right? So you can't completely DeFi it because there's a coupon that you need to collect on, and someone's going to have to pay you back the cash that you invested once the bonds come to maturity. Now, obviously, currencies don't have that. But if you think about, and again, you know, we could talk about this, you know, for another full session as well. But basically, if you think about government bonds versus government's currency, it's actually the same counterparty. It's the government that issues one without a maturity, but also doesn't give you a coupon, but one with a coupon, but with a maturity, meaning that they're borrowing money and they'll pay you back after a certain period of time. Now, this used to be very high denomination bonds, and this used to be very low denominations in coins, or let's not use the word coins because that's another thing altogether. Let's say very low banknotes. But now if you reduce this down and make it the same, and you have a $1 bond, $1 currency, then and then one bears interest, one does not bear interest. If you want this to bear interest, you have to put it in a financial institution that gives you interest. But this in itself has interest. The guy who issued it is the same guy. Then what's the difference? So eventually, I think there's definitely going to be a merging or melting pot point around this. But there were two financial instruments created for different purposes that can exist. But there is a world that I imagine where I'll pay for a Coke with $5 worth of bonds rather than paying cash.
Yeah, I think we are running pretty late for this session. That was so passionate and a lot of things to share. Maybe we didn't talk about your journey as a person. We talked about the landscape. We talked about the project you have run together. We talked about technology a lot. How did you start this journey? How did you decide to work with, Created Liberty or work on those projects? Can you tell us a little bit what attracted you to do this? Haron, you want to start?
Yeah, sure. I'm not very good at my job, so I was trying to find a second job that I could go into. No, I think after looking at the bond markets for and I'm literally in my 20th year of doing bonds or helping issuers issue bonds, and sovereigns are a big part of my my clientele. And it's really the biggest issues that they had in trying to encourage more lower denomination in retail bonds, in actually trying to encourage more direct trading or just trading in general within holders of retail bonds. And these are two things that governments around the world have struggled with. And I believe that there is a technological solution to do that. And I think it's the right thing to do. It's, again, something that should be there. It's evolved. The bond markets have evolved in this way because it was an institutional market to begin with. And that's why this exists like this today, but it doesn't have to. If people think about it a little bit deeper, it's very simple. It's just an IOU by the government. Any citizen of the country should absolutely be eligible to buy it, no matter how small. And so that's the gap that I thought needed to be filled. And if the way to do that would be to try and see if I can make a difference myself, then so be it. But yeah, I'm trying to solve I guess I'm still trying to solve a problem for my clients.
Thank you. What about you, Benedict? Completely different role, but I always seen you very passionate and energetic, I should say. A lot of energies when it's about talking such a topic. So tell us a little bit more. Why?
Yeah, so in the context of DeFi and everything crypto, so actually, funnily enough, my journey started when I was in the securities regulator, and I saw the first derivatives trading platforms. So I mean, Bitcoin futures platforms, right? So this was around 2014, and at the time, I personally thought this was a pretty big thing, but I can tell you, everybody thought it was a pretty small thing. So about 3 years later, when I left the securities regulator, so I left then the securities field, and I joined a company that launched, which is now the biggest global regulated stablecoin. And as I saw that, I saw that what crypto had been pursuing is indeed, as Radko also emphasized, this peer-to-peer thing. Whether it's peer-to-peer of anything is what's really pursuing. And the stable coins pursue peer-to-peer payments. So I'd gone from looking at the Bitcoin futures, which in my view, already then, they come very close to securities law, which is a point that securities regulators are now starting to grapple with. But secondly, on the peer-to-peer payment, you could see how fast these things could happen through new technologies. And so in my current role, actually, aside from managing this Genesis project, I also need to think about central bank digital currency. So how do we make our central bank currency digital and more efficient or lower cost than it is today, and specifically lower cost on cross-border transfer? Because the high cost is actually on cross-border transfer. And it's actually not that dissimilar from the analogies we're talking here with Aaron as well. Is Aaron just mentioned that bond markets were inaccessible for retail investors because no one tailored them to retail investors. No one tailored them fractionalized, and fractionalized was too expensive. Similarly, so cross-border payment actually is really expensive on the small amounts. It's actually not a big deal nearly on the big amounts, but on the small amounts, it's quite humongous. So in sum, my journey is really all the time to look at disruptive innovation, you could say, but to look at it from the perspective like, why is it there? It's normally there for a reason. And as you then look at it, then you unveil what it's trying to improve. But at the same time, of course, coming from perspective of regulation, I know you need to mutate these things into a form where they can be for broader social use and acceptance. And that's where regulation does come into the picture, as we started this panel with. Anyway, that's just give you a feeling. It looks like it's many different things, but in fact, it is actually one progression. It's not, and in between at Standard Chartered, by the way, I also applied for the license for Zodia, which is your crypto custodian. Yeah.
And maybe Radko, good also to hear your journey and your experience, and why DeFi or.
Well, I started my career in a bank in sales and trading of structured products at Deutsche Bank London. So early on in my career, I was pretty excited about financial services. But at some point, I had a very strong motivation to start something on my own. And in 2012, I first heard about Bitcoin, about cryptocurrencies. So I got excited about it very quickly. And then started to utilize the technology for different things. And ultimately in 2019 at Bitbond, we issued Germany's first tokenized bond, where the regulator approved a securities prospectus for what you could also call a dematerialized security. And as a part of that, we had so much interest and demand from financial institutions, from larger issuers, how they could utilize tokenization as well. That we actually focused the company fully on that part. And so we have evolved into a technology provider for banks and other financial institutions around tokenization and digital asset custody. And yeah, I think as we've seen in this discussion, it's, in my view, one of the most exciting areas of finance and of technology today. So yeah, this is what I'm sure we're going to keep doing for at least another.
And I'm sure this is just the beginning of the journey, right?
Yeah.
Based on the different conversation we have today, there's still a lot of things to be, let's say, maybe some concern, maybe some things to fix or to evolve. So I think it's just the beginning of the journey in the evolution of DeFi.
And I think, just like Bitbon is working with us on a number of different projects. If you're a fintech and you're interested in working with us, so I think there's the Fintech Bridge.
Correct. Yes. So as we mentioned at the beginning of the session, we talked about live streaming session called Fintech Bridge Podcast. So SC Ventures has built a platform called Fintech Bridge, which purpose is to connect startup people from the bank and also our corporate client around problem to solve, but it could be also how you can find a new connection. We also share a lot of content. So typically the content that we are currently building at the moment, we are creating with this podcast is also available on the platform. You will find also article, other type of content about not only SC Ventures, by the way, but also startup we work with us, we want to partner, but also with our client, and it's all about connecting people. So yes, if you're a startup and you want to be, and you see probably behind us the screen, this is the homepage of the platform, and we're going to share on LinkedIn also. Please reach. It's just a question of creating a profile, sharing what is about your company. You can post video page so that it's seen by all the different stakeholders and members of this platform. We have almost 2,000 people on the platform. So don't hesitate, go ahead. And of course, we will be glad to have more startup around DeFi on the platform to connect with other potential client investors, etc. I think it's time to wrap up, right?
It is. I think we've gone over time for more than 20 minutes.
But it's a good sign, right? It means that we have passionate speaker season, a lot of things to share. So we are always very exciting to have such conversation.
And we've received quite a number of solicitations, actually. So if that's okay, we'll probably redirect them your way to the three speakers today. Thanks a lot for your participation.
Thanks for your time, energy, passion in this conversation. And I think, yes, the next podcast, that will be in the context of the Singapore FinTech Festival, where we're going to have a series of lots of podcasts around, there is some around DeFi, there is a podcast around embedded finance. We're going to talk also about quantum computing, a lot of different technology, a lot of different topic use cases. We're going to talk also about sustainability. So that would be quite exciting. So for the audience, of course, stay tuned. And for our speaker, don't hesitate to join us in the session. Aaron, I think you have one for you, by the way, talking about liberty and sharing your solution and your journey. Thank you very much.
Thank you, everyone.
Yeah.
Thank you.
For your session.
Thank you.
Today. Bye.